Okay, today's bank is CVB Financial Corp. They're located in California, and ticker of CVBF. They've got about 65 branches. I believe they're all in California, so really geographically isolated to California, and relatively bigger bank, I think. So looking at the Yahoo Finance page, we can see it's about a $2.3 billion bank. So that's a little on the high side compared to, the general population of population of banks in our data set. So yeah, they've got a price earnings ratio of about 11. I believe that's an earnings yield of about 9%. That's pretty low. We're usually looking for at least 9.5, 10%, something like that. So a little bit on the lower end. And if we look at the statistics page, we can look at the price to book ratio as well. It's about 1.12. That might be a little on the higher side. We're looking for somewhere between, I think, 0.85 and 1.05, something like that. But that's can depend on the composition of whether they have available for sale or held to maturity securities and stuff like that. So can't really hang your hat on just the price to book ratio without looking at it a little bit deeper. Same thing with the price to earnings ratio. But so if we come down to some of the earnings ratios, we can see return on assets of 1.29%, and that's a fantastic return on assets. That's a lot. For most of the banks right now, we'd see something like 0.8 to 1.05% on an average range. So that's a really good return on assets. Return on equity is really good as well. So we can see, actually these profit margins are really good as well. So we can see that the bank is perhaps really profitable, but perhaps the price might be a little bit expensive relative to that of the average bank. So once we dive in, we'll be able to see if that price makes sense or if it's too much, etc. So let's start going down the balance sheet. We can see they've got almost $1 billion of cash, 950 million plus 12 million or so. So and that's a pretty good amount. That's almost 6% of the assets. And most of the banks that we see somewhere between 4 and 6%. So that's a little bit on the high end. And that would mean the bank is perhaps a little more liquid than the average bank. And then also looking at the securities, they've got 5.3 billion, and that represents probably about 32% of the assets. So that's really high as well. That could almost be double what we would typically see, almost double. So they've got more cash, more securities. So it seems like they're a really liquid bank. And of course, yeah. So then we've got the loans, which is about 8.7 billion, and that's a pretty small percentage of the assets compared to what we would see for most banks. So 53%, and most banks end up with the loans on their balance sheet ends up between 68 and 74%. So they've got a lot higher allocation towards securities than they do to loans, and that is provides perhaps a lower return, but also more liquidity and perhaps a lower risk, at least in the capital and liquidity side of things. So I would expect that probably the net income or the interest income is a little bit lower than what we would normally see for most banks, just because they're more allocated toward securities, which has a lower yield than loans do. So we'll see that once we get to the income statement. Maybe that's whether or not that's the case. They also have a pretty high amount of goodwill, and that's almost 5% of the assets. Normally we'll see somewhere around 1 to 1.5% of the assets would be goodwill for most banks. So I guess in the past these guys have been really acquisitive and added some goodwill when their purchases exceeded the net asset value of the banks that they bought. So, or whatever else they bought. So goodwill's kind of it's not yielding anything. Implicitly you would think or hope that synergies from the acquisitions gave them some extra earnings, but if that's the case, this would all be up in these assets, right? So we kind of consider the goodwill as sort of an asset that doesn't provide any yield, and so in a lot of the calculations where we're doing tangible return on assets, tangible common equity ratio, and even when we eventually convert everything to fair value and see what's the value, we take out the goodwill. So kind of a dead asset there, and it's a little bit more than what we typically see for most banks. It's kind of sitting there. Anyway, so that might come up later once we look into the composition of the footnotes. Anyway, so coming down to the liability side, so we've got $7.1 billion of non-interest deposits, and that looks like a lot. Let's see. So, yeah, that's about 50% of liabilities are non-interest bearing. Wow, that's incredible. So they basically have half their liability side is funds that don't have any cost that they can lend out or purchase securities with. So that's fantastic. So it seems like they would more than likely have a pretty low interest expense compared to most banks, because most banks, would have around 20 to 25% non-interest deposits, but these guys have 50%, so basically double. So the cost of funds for this bank should be a lot lower, and we'll see that perhaps when we get to the income statement shortly. And then they've also got about $2 billion of debt, and I think most of that's FHLB borrowings, and we'll see a little bit later if that's the case. And that's about 14%, and that's about double what we would normally see. So really heavily weighted to non-interest bearing deposits, which is awesome. And then a little bit more debt than we would see for most banks, but since they've got so much non-interest bearing deposits, it probably doesn't have a huge effect on the interest expense in a negative way. And then pretty small amount of interest-bearing deposits, this $4.8 billion. It's about 33% of the liabilities, which is really small. It's about half what we would normally see. So seems like they have a really good cost of funds here, and able to draw perhaps good relationships with their customers to be able to have so much deposits that they don't have to pay for. So let's get down to the income statement. So we can see total interest income $158 million, and that ends up to be 4.22% of assets, and that's really, really low, especially right now for this quarter. Because this quarter, we're typically seeing, somewhere around 6%. So, in a lot of cases. So, even compared to the past year or so, that's really low, really low. So, in our population currently, we're seeing something around at least 5% of yield on earnings divided by the assets. So maybe our thought process was correct, and from the perspective of, they're pretty heavily weighted towards securities, so not earning as high of a yield. And I can also see that the securities here, this 35 million that they're earning, is a pretty low yield as well. It's about 2.63% yield on the securities that are on the balance sheet, and that's really, really low. I mean, we're seeing these days at least 3% on the securities. So, not only do they have a higher allocation to securities, but they also are not yielding as high as the typical bank. So that's sort of dragging their interest income down. But hopefully, from our thought process on the liability side, maybe their interest expense is lower also. So we'll see. Interest deposits plus borrowings and repurchase agreements. It gets us to about 45 million of interest expense, and that is 1.28%. So that is a really, really low percentage of assets. Probably, half or more, or half or less of the typical bank. I mean, we're seeing at least 2% for over the past year, and then more recently, 3, 4, 5, a little over 3 and 4% of assets as interest expense. So these guys are saving a whole lot of money by utilizing non-interest bearing deposits. Yeah. And then the interest on debt and the repurchase agreements averages out to about 4.32%, which actually isn't that bad these days either. This can end up being up, about 5%. So they're doing a really good job managing the cost of funds, and that's sort of keeping their the interest expense down. And for whatever reason, they're have the higher allocation to securities up here is sort of keeping their net interest income down, unfortunately. But so let's see how that ends up on the net interest income. So it's 112 million. That is 2.73%. We're usually looking for at least 3% or so. The average range is something like 2.8 to 3.2. So 2.73% is a little bit on the low end. Unfortunately, I guess the interest income was too low to bring this net interest income into a normal average range. But it's not, too far outside the norm. So coming down to the non-interest income, they've got some trust and investment services, which adds a little bit to the non-interest income, so that's good. 14 million turns out to be about 8% of revenue, which is on the low end. We usually see somewhere between like 10 and 14% of revenue. So, not as much non-interest income as well. But coming down to the non-interest expense, we've got about 60 million, it looks like, and that's 35%. So 35% is really low. We usually see somewhere between like 42 and 47%. So, they're saving, or they do a really good job on the cost side of things, with lower interest expense, lower non-interest expense. But on the revenue side, it seems like they, are leaving a lot of potential revenue on the table, the way that they're operating the revenue side. And I don't know if that's because they're more cautious, or maybe they have a tough time originating loans, so they have to buy securities. It's either that or hold cash, right? So anyway, so all that boils down to about 49 million of net income, which is about a 1.18% return on assets, and that's really, really good. We usually see somewhere between 0.8 and 1.05%, something like that. So, they're making really good money on the assets that they have, and a lot of it is due to controlling the cost side of things. And if they were able to allocate their assets to the more riskier areas, they could potentially earn a little bit more money or add some non-interest income through additional services, or beef up their sales in that aspect. But as it is, 1.18% return on assets is fantastic in itself. So anyway, so if we were to compare that to the market price currently, so the market cap's about 2.3 billion currently. 2.33. So then 48 million annualized, so multiply it by 4, gets us an earnings yield of about 8.33%, which is below what we would normally want to buy a bank for. We typically would want the earnings yield to be somewhere between like 9.5 and 11, so 9.5 and 11%. So 8.33% is really, really low. We would prefer to have a higher yield, and so in order for that to happen, the market price would have to come down. So either that or they make more money. But as it is, 1.18% return on assets is a huge accomplishment in itself. So I wouldn't expect them to need or want to make more money, but I would expect the stock price to come down to be more in line with what the average bank is being traded at currently. And of course, we haven't gone through any of the risks or growth considerations yet. So those things factor into the PE ratio, the earnings yield, and stuff too. So it could turn out to where the risks are very, very muted, and the growth is expected to be astronomical. And so then it might make sense that we would pay more for a bank, right? But just in a vacuum, looking at the earnings, I can see that the price I would have to pay for the bank is higher than I normally would. But anyway, so let's keep going to the footnotes, and we can learn a little bit more about the bank as well as some of its risks and whether the price in the market currently makes sense. Yep, so the holding company holds Citizens Business Bank, and they also have Citizens Trust Division, which provides the trust and investment related services that we saw in the non-interest income. 62 banking centers, 3 trust offices, headquartered in Ontario, California. So looking at the investment securities, we saw that a little over 30% of the assets is investments. So some investments would be important for us to get a good understanding of. It looks like, as is the case for most all banks, the mortgage-backed securities make up most of the security portfolio, about 81%. So there's about $4 billion in mortgage-backed securities here. And so mortgage-backed securities typically come with government guarantee, either explicit or implicit. But then the rest of them are U.S. agencies or municipal bonds. So so it seems like most of the security portfolio is we could perceive as being riskless. Yeah, and they explain that a little bit further here. About 90% of the portfolio is invested in securities issued by the U.S. government or GSEs. So, implied guarantee of payment of principal and interest. It looks like everything else is AA or better. So that's fantastic credit quality. So they didn't record an allowance for credit losses. So, and that makes sense, if at least 90% of the securities are, riskless, and then the rest of them are highly investment grade, zero Zero allowance seems to make sense. We do have a big unrealized loss here, which isn't outside the norm currently. Most banks have a big unrealized loss on their securities portfolio, especially because they're oftentimes pretty long duration securities. But recently, the interest rates increased really rapidly, and so when interest rates increase, then the value of the securities in your portfolio goes down. But that's not uncommon, so nothing that we concern ourselves over. And we can see here the term structure of the securities. When do they mature? And it looks like maybe about 50% of them mature in 5 to 10 years from now, and then another 50% mature longer than 10 years from now. So we've got a really long duration securities portfolio, and that's really unfortunate because they, as we saw, the securities are, when we were looking at the income statement, the securities are yielding a pretty low yield compared to what most banks have on their balance sheet currently. So they're sort of trapped into these securities for at least 5-10 years at these lower yields. And but we'll be able to see a little bit more once we get into the interest rate risk disclosures and stuff about, and compare it to the timing of the repricing of the loans and the debt and the deposits, and we'll be able to tell whether that is a big risk or not. If they have a lot of loans that are repricing pretty quickly, then that might offset a lot of the later repricing of the securities. But we'll explore that when we get to it. All right, so the loans, we saw they've got about 53% of the assets as loans. So, pretty material part of the balance sheet, so we want to make sure that we understand them well. We can see that most of the portfolio is in commercial real estate. It looks like about 76% of the loan portfolio is commercial real estate, which is a high amount. I mean, it's basically about double what we would see for most banks as a percentage of the loan portfolio. So very heavily weighted into commercial real estate. The next biggest bucket is C&I, so $963 million. We also throw in the SBA loans into business type loans. So really, it's a very, very commercial bank. All of the loans, probably 96-97% of the loans are to businesses. So that's a pretty high concentration. And also, lately, as we've seen for most of the banks that we've been looking at, the C&I and commercial real estate loans have been come with a pretty high credit risk. So we can start diving into some of those disclosures here and see if that's the case for this bank. So I like to look at the classified loans, so the ones that are substandard, doubtful, and loss. And we can see commercial real estate has about $90 million classified, construction's 2.1, so on and so forth. So if we were to add all those up, all the classified loans, so that works out to $103 million, and that's about 1.18% of loans, and that's within the range that we would typically see for most banks. Most banks, their classified loans are somewhere between 1.10, 1.7% of their loans. So not too bad. And so we can scroll down a little bit more and see, what do the past dues look like, what do the non-accruals look like. But first, talking a little bit about the ACL. So it looks like the reserve is about $82.8 million, and that represents about 0.95% of loans, and that's pretty low compared to what we would typically see. Most banks have a reserve that's about 1.10 to 1.26% of loans. So, having a 0.95% reserve is a little bit on the low end than, for what we would see for most banks. And if we were to compare that 82.9 million to the classified loans, which was 103 million, we can see that that percentage is about 80%, which is below what we would typically see. We would typically see somewhere, at least 90-95% of classified loans being reserved by the ACL. That's not the case. So it seems like there could be a possibility where they don't have a high enough reserve, and but it doesn't seem like it's by much, right? So 103 million compared to 82 million was about $20 million. But not to say that their reserve should equal the classified loans, right? That's just sort of where the average bank ends up. And, they're definitely not going to lose all 103 million of the classified loans, I wouldn't think. There could be a chance. But anyway, so let's look more at the non-accruals and past dues and stuff, and we can maybe determine, how bad is the loan portfolio. Maybe it's, not a big issue. I mean, we can see that the past dues is 33.4. That's about 0.38%. That's really, really low for the amount of past dues. And non-accrual looks like 13.8, and it's 0.16% of loans. That's really, really low also. So it seems like the loan portfolio has a really low amount of non-accruals, low amount of past dues, but somehow the classified loans are a little bit higher than what we've seen. So it almost seems like if it could make sense if the reserve is a little bit lower compared to the classified loans than what we would typically prefer, if there's not a whole lot of evidence of issues being in the loan portfolio, which is sort of what we're seeing here, with not having much past due loans, not having much non-accruals. But I mean, they are really heavily weighted toward commercial real estate and C&I, which really should garner a higher reserve. So anyway, that's a toughie. It almost seems like there should be a little bit higher of a reserve, but you probably could make the argument that with no past dues, no non-accruals, that it would make sense for it to be a little bit lower than is typical. And especially only 1.3 million of the loans were modified, and they don't have a whole lot that's been sitting out there, $10 million of TDRs. As we've seen for the past couple banks that we looked at, I mean, they had a crazy high amount of TDRs, or loans that have been modified so that the customer is able to pay. So I feel like you could make the argument that the credit quality of the loan portfolio is lower, and perhaps that makes it reasonable to have a little bit lower reserve. Although I do want to still be cautious about there being classified loans there. But as we saw, the classified loans is a little bit on the lower end of the range of what we would normally see. So anyway, that's a toughie. But we can continue going and make those considerations at the end once we put everything together, right? And so, all right, we're down in the section about the borrowings. This will tell us a little bit more about the debt. All right, so it looks like about $2 billion is from the Fed's Bank Term Funding Program, which was about a one-year loan program. So those are coming due, or part of them matured in May 2024, and then the rest of them coming due in January 2025. So those are all really short-term loans that will reprice within a year. They also have repurchase agreements, $275 million, that reprice overnight. Yeah, so basically their entire debt portfolio reprices within the next year. So it's a really quick turnaround there. And at that point, they'll need to potentially pay higher interest rates on them. But fortunately, as we saw, a lot of their balance sheet is non-interest-bearing deposits. So hopefully that doesn't have a big effect on their net income, or at least as big of an effect as another bank that doesn't have so much non-interest-bearing deposits. So that's awesome. But we'll be able to look at the repricing of that once we look more at the bigger picture. But these yields aren't too bad. When they reprice, it might be a little bit higher. And so we'll see, when we look at this bank next year, we'll be able to see how much it changed. Skipping through here, we can get to the fair value information. So we always like to compare the carrying amount of their assets and liabilities to the fair value amount. And held to maturity securities will have a difference, and so will loans, and also time deposits and borrowings. So we can kind of convert all the amounts that are on the balance sheet to fair values and see how does the bank look from a valuation standpoint, but also from a capital adequacy standpoint, right? All right, so the difference between held to maturity and the carrying value and the fair value is about $400 million. Same thing for loans, about $400 million. So that's a total of about $800 million decrease in the equity to convert it to fair value. And there's also some minor differences on the liability side, not a whole lot, about $70 million. So all that together decreases equity by about 36%, which is a little bit on the high end. And that puts us over the norm. So the price to fair value of net assets, so the assets minus the liabilities at fair value compared to the market price, means we would be paying a multiple of about 4.22 times the net assets at fair value, the tangible net assets at fair value. So taking out the value of goodwill, which is on the balance sheet, which we saw was kind of a higher amount than we normally see for a bank. So if we were considering the net asset value of the bank at fair value, excluding the goodwill and intangibles, we'd be paying 4 times that for the bank, which that's about double or more than what we would normally see the price to be for most banks. So that seems pretty expensive, especially in light of where we saw bank the credit risk that we were just looking at. Anyway, so that's a consideration that we can make. But also, if we, by doing the same thing and doing sort of a common equity ratio, so that net assets at fair value divided by the value of the assets gets us about 3.72%. So that's a really low capital ratio as well. So the capital of the bank relative to the net capital relative to its assets is a pretty low amount when you look at it at fair value. We would normally see something like 5 to 7% at least, but being less than 4, that leads us to believe that possibly there's they would need to increase their capital a little bit more. So we'll be able to make those considerations once we get more into the capital adequacy discussion. But that's interesting to note is converting all this stuff to fair value puts the bank at a position where its capital is not as robust as what the typical bank's capital might be. But okay, let's keep going. As far as the derivatives go, they've got both fair value and cash flow hedges. They've got about $1 billion of fair value hedges, and those are hedging the available for sale securities. So that's awesome. One of our concerns was that the securities are pretty long duration, and but also at really low fixed rates. But by fixing the fair value, they are protecting themselves against the loss of value there, which that's a great plan. And $1 billion hedge, they have about 2.8 billion of securities on their balance sheet. So it's a little over a third of their securities they're hedging against increasing interest rates, which I think is fantastic. And also on the cash flow hedges, they've got $300 million that they are using to hedge brokered CDs. So they're hedging the risk that if interest rates were to go up, they're basically fixing the interest rates on their brokered CDs, which I think is awesome as well. So both of those the fair value and cash flow hedges that they have in place right here, I think are in the right direction. And once we paint the bigger picture of the interest rate risk, we'll add in those derivatives to see how much does that help the interest repricing risk. Yep, so let's keep on going here. This might be the end of the pertinent footnotes. Yeah, so we're getting into the MD&A now. We can see a little bit more of the yields on the assets and more about the liquidity of the bank and capital adequacy, all that kind of stuff. But first, they sort of put together a lot of the ratios we've already looked at. Return on assets, 1.21%. That's fantastic. Efficiency ratio is really, really good too. With this, we want it the lower the better. We'll typically see 65% or so. So 47% is really low. It's basically the non-interest expenses divided by the revenue, with a few little adjustments, but that's basically it. So yeah, so really good profitability metrics that they have here. Alright, so yeah, we can see the yields here, 4.34% of earning assets. That's really, really low. That's way below the range that we normally see. I mean, right now we're seeing stuff at least, 5.5%, something like that. So, even higher than that. So this is pretty low yield for the interest earning assets, and perhaps that's because, as we were talking about, not most, but several of the interest earning assets are securities, and they're at a lower rate than is typically the case, but also at a higher allocation on the balance sheet. So it's really eating into the interest income. But also, looking at the loans yield, 5.3%, that's pretty low. Especially considering they have C&I loans and commercial real estate. I mean, we would expect those to be at higher yields as well. But as is the case, 5.3%. I mean, we've been seeing stuff that's like 6 to 7% lately. But to save them, they have a really low interest-bearing liabilities yield. Savings deposits pretty low. We've been seeing some 3-4% lately, and then time deposits as well. It's pretty low. And then even the borrowings is pretty low. Typically see something, around 5% or more lately for this quarter. So these guys are saving a lot of money on the funding cost, and 2.69% is really low as well, at least for this quarter. So that's putting them at a really good net interest margin. As we've said, we're looking for somewhere around 3% at least. So it's a really good net interest margin. Unfortunately, the non-interest income wasn't as much as what we typically see, although it looks like it's growing a little bit. So, but they do have really, really cheap non-interest expense. So it gives them a pretty low efficiency ratio, which is fantastic. So they're really making good money. Doing a great job on the cost side of things. And if they could somehow get the revenue up to match, that would be really helpful to boost their earnings even further. All right, so we talked a lot about the loans and other areas of the balance sheet, so I think we can skip through that and get more to the liquidity, capital type disclosures. Yeah. All right, so capital ratios these are actually really good. So these ratios are all above what we would normally see for most banks. So, I think that it's mostly due to having a higher allocation to securities. So especially the risk-based, where the securities have less risk than loans do and don't get dinged as much as the loans do. So really good capital position, at least from the regulatory standpoint. Although we did see, like, when you convert everything to fair value on the balance sheet, their net assets are a lot lower than what we would normally see for most banks. So, but they're more allocated toward securities. So, does that mean that perhaps they don't necessarily need as much capital because a higher percentage of their assets are allocated toward lower risk? I feel like that could be an argument that you make, but I would certainly prefer there to be a more robust capital position, and especially at fair value, right? Because that's telling us truly how much capital is there at its current market value. But from a liquidity standpoint, we talked a lot about how they have more cash, they have more securities. A lot of securities are pretty long duration, and we can look at the call report to see the repricing timing of the debt, the loans and the debt and deposits and everything, and as well as the derivatives, or consider the derivatives to put together sort of a calculation of how much is going to reprice within the next year, and how does that compare to other banks, and is that too risky or in a good place? But after we did our calculation, we saw that there's almost $1 billion of cash, and then most of the securities are pledged. So basically all of the securities are pledged. So there's no unencumbered securities on the balance sheet currently. And so if really all we can use for our on-balance sheet liquidity ratio is about $1 billion of cash, right? And so that's about 8.5% of deposits, which is on the low end. We would typically see somewhere between 13 and 18%. So being on the 8 to 9% of as a percentage of deposits is it's not very high, especially as a percentage of uninsured deposits. It's about 142%, which is on the low end as well. We normally see something like somewhere in the 200s percent. So in light of that, the on-balance sheet liquidity might be a little bit lower than what we normally see for most banks, mostly because all the securities are pledged. But on the flip side, they've pledged those securities so that they can have some collateral in place to borrow if they need to from the FHLB. So some of them are pledged for deposits, right? But as it is, they're able to borrow about, I believe, about 5.8 billion. Some of that coming from the FHLB, some of that coming from the Federal Reserve, some of that from correspondent banks. But that puts them at a place to where, when you add in, how much availability they have to borrow, plus the on-balance sheet liquidity they have, is about 86% of deposits. So that's higher than we would normally see. Typically, we see like 70 to 80%. So adding in the off-balance sheet liquidity where they can borrow more gives them enough liquidity to be able to continue operating. So I don't think that there's a case where their liquidity is in a poor position, where they wouldn't be able to fund their operations or liabilities as they come due. And from a capital standpoint, the assets to equity ratio is about 8 times, which is pretty low as well. Normally see somewhere between like 10 and 11 times. So they're not as leveraged as what most banks are, but also we saw they're more allocated toward riskless assets like the mortgage-backed securities, right? Looking at some more traditional ratios, we can see the common equity ratio is like 13, or it's like 12.5%. Normally we see 9 to 10%. So from that ratio, we can make the case that they're really well capitalized. But once we convert everything to fair value and we take out the intangible assets like the goodwill, we get below where a normal average bank is for capital amount of capital. So all that together, I could say that I would prefer that they have more capital, but I don't think that it's a big problem that they don't. So we can kind of make those considerations once we paint the big picture. But going into the interest rate risk, we can see that if interest rates go up, net interest income goes up. If interest rates go down, net interest income goes down. So perhaps they're a little bit asset sensitive. Yeah, so that's what they say here. It's modestly asset sensitive. So that's awesome. That's how I prefer them to be. But also, seems relatively neutral, like a little bit leaning toward asset sensitive, which I like, but also in a place where no matter which way interest rates go, it's not going to change net interest income that much. And that's the definition of risk, right? Is volatility. So we're trying to keep keep it to where we can predict net interest income as close as possible. So in this case, with it seeming so neutral, it seems like a pretty low net interest income or interest rate repricing risk. But if we we did our own calculations based on the repricing timing of call report and the assets and liabilities of the balance sheet, and we found that the asset liability position of the bank is pretty average with the way that most banks are positioned currently. So even though we saw that securities are pretty long duration at low interest rates, which presents a risk to us, we've got a really large percentage of the liabilities, like 60%, that don't have interest at all. So that means, those don't reprice, and so there's, I guess there's a risk that those, migrate into the interest earning categories. But, as it is, there's a lot less liabilities that earn interest to reprice on the balance sheet. So that means there's not as much assets that need to reprice sooner to keep that ratio down, right? And I think that's what's giving them the ability to be slightly asset sensitive. But, also we saw, they've got the derivatives in place that are hedging, keeping the asset side floating, the fixed rate securities. So $1 billion of them are becoming floating. But on the liability side, also keeping a lot of the broker deposits fixed. So, those things together, I think, are netting each other out to make the balance sheet fairly, asset liability neutral. So I think they do a really good job of that. They do about half of their loan portfolio reprices in 5 to 15 years. So that could be a risk down the road. But as it is, like right in the next year, interest rate risk seems to be low. And so I think that is the end of things. They also have $4.3 million or 4.3 million shares that they've been authorized to repurchase. So they could repurchase shares if they wanted to. That represents about 3%, which is a pretty average amount. So not too big of a consideration to make. Anyway, so we're at the end, and we can sort of bring all this together and figure out, is this a bank that we would want to buy, that, we would want to buy the earnings, the net assets, and at the risks that are currently in place right now. So we did see that the profitability of the bank is really, really good. On the cost side, they're saving a lot of money on the, especially on the interest expense side, because they have a large percentage of the deposits that are non-interest bearing. But also the non-interest expense is really low compared to most banks, so they're really doing a good job keeping costs down. But also they are keeping the interest income down by being more allocated to lower yielding securities, and also not having as much non-interest income as what most banks might have. So they end up having a pretty average return on assets, pretty average profitability bank, which is also really good. So keeping that in perspective, compared to the market price of the bank currently, that puts them at a pretty low earnings yield. So the earnings are pretty good, but the price of the bank is pretty high compared to those earnings. It's about 8.33% earnings yield, I think, and we're normally looking for like 9.5 to 11%. Now, if the bank's risk or growth were in a place to where it would it would make sense to make less money because we're don't have as much risk of those earnings going down, then we could make the case that the earnings yield being lower is okay. But I don't think that that's the case, given a lot of the risks that we talked about going along. So we saw that the credit risk, there could be a potential for some issues there. We can't predict the future, but we did see that there's a lot of, it's actually sort of an average amount of classified loans in the loan portfolio, but their reserve, the allowance for credit loss, is a lot lower than what the typical bank would have, at least when you're comparing it to the classified loans, right? But they do have a lot less past dues. They have a lot less non-accruals, a lot less TDRs. So it's almost like there's starting to be some issues identified in the loan portfolio that's showing up in the classified loans, but that hasn't become such an issue just yet to where the customers are getting behind on payments and stuff like that. So that's a tough one because you could, definitely make the argument that, hey, the reserve is enough, but you could also make the argument that, hey, we would prefer the reserve to be a little bit more. And the difference between the classified loans and the reserve is only about $20 million. And the net income of the bank this quarter was, $50 million. So if you were to annualize that, that'd be basically $200 million. So would a $20 million additional, provision be that material? It could be, given that the bank just has average earnings, and the price seemed to be pretty expensive for those earnings already. So I just feel like that's a risk that maybe we would prefer not to take at the current price of the bank, right? If the bank was yielding a lot more, if it was yielding more earnings compared to the price, we might be willing to take that risk that, if the earnings went down a little bit, that might be okay because we're getting the bank at a pretty good price, right? But that's not the case here. The bank is priced a little bit high relative to its earnings before even considering the risks. So so that's the credit risk. We also saw that the capital risk might, you could possibly make the argument that you would want to have a little bit more capital in place, especially given that once converting everything to fair value, it puts it at a pretty low ratio. The common equity ratio at fair value, tangible fair value, especially because they have a lot of goodwill on the balance sheet, right? So, but the on-balance sheet liquidity was a little bit lower than what we typically see, but that's mostly just because they've pledged like all their securities. But they have the ability to borrow a lot from the federal FHLB, the Federal Reserve, which shores that up, and that's the purpose of pledging it anyway. They also have to pledge some for deposits as well. But once you consider both the on-balance sheet and off-balance sheet liquidity, you end up with a pretty good capital position, or liquidity position at least. So I couldn't see there being a place where they could not continue operating or could not get the necessary liquidity that they need in order to fund liabilities coming due or anything like that. All that to say, I think that the capital position could be better, but I don't think it hinders the bank that it's not better. Of course, that could be another consideration that we would think maybe our earnings yield should be a little bit higher just to mitigate our risks there. But as we've already noted, the earnings yield's too low as it is. But the saving grace is that the interest risk is really, really low. I like the asset liability setup of the bank currently, where it's fairly neutral, right? If not a little bit on the asset sensitivity side, at least over the next year. So that protects us from there being a big change in net interest income over the next year. We really liked the net interest income. At least the funding cost side was really, really cheap. It would be pretty cool if they were able to increase their interest income, but as we saw, they half of their loan portfolio doesn't reprice for at least another 5 years. So they're and we saw that the loans are yielding really low amounts compared to what's out in the market currently. So that's gonna keep them at a lower yield, and also being more allocated towards securities, and the securities are at really low yields as well. So I feel like they could possibly be trapped into lower interest income for a long time. But on the funding side, on the liability side, they have a really high amount of non-interest bearing deposits, which offsets the lower interest income and kind of keeps them profitable. So anyway, I think the interest risk is low, but several years down from here, it could become a problem. Anyway, so in conclusion, I think the risk, the market price for the bank is too expensive for the risks that are there, and so I don't think that it would be a good buy at its current market price. If the price were to come down a little bit, it might make a little more sense, but as it is, I think we're gonna pass it by. Anyways, so let me know if there's anything I missed, or if something that I could clarify, or something that interests you. Let me know. Leave whatever comments you have down below, and thank you for listening.